You've seen it, right? The ads, the influencers, they're all promising this dream of financial freedom, trading from a laptop on some beautiful beach. Day trading gets sold as this ultimate shortcut to getting rich fast. But what does the hard evidence actually say? Well, let's dive right in and dissect the anatomy of why this super popular strategy almost always ends in financial failure. I mean, it's the multi-million-dollar question, isn't it? Can you, as a regular person, really beat the market and get rich making these rapid, daily trades? Let's unpack that.
Okay, so the answer, right out of the gate, is just a total statistical gut punch. Get this. Based on some really robust studies of the Brazilian market, a staggering 99.4%, that's almost everyone, 99.4% of people who try day trading lose money and just give up. And look, this isn't just bad luck, it's a predictable outcome. So let's find out why.
To really get why so many people fail, we have to look at the game itself. Think of it like a casino. The system is built with these structural barriers that put the average person, you, at a huge disadvantage from the very second you place your first trade. And the data is just remarkably consistent on this. I mean, whether you're looking at the 99.4% who quit after losing or the 97% who show any kind of net loss, the message is loud and clear. And this isn't just some weird thing happening in Brazil either. Nope. Studies in the US confirm the same thing. The average individual investor consistently fails to even match the return of a simple S&P 500 index fund. Think about that. You'd have made more money just buying one thing and doing nothing. The key takeaway here is that the odds are just overwhelmingly stacked against you before you even start. So why is it so incredibly hard to actually make a profit? Well, a huge part of the answer is just friction. They call it death by 1,000 cuts for a reason. See, day trading is all about making tons of trades, dozens, sometimes hundreds, just to capture these tiny little price movements. But here's the kicker. Every single one of those trades gets hit with costs. You've got brokerage fees, exchange fees, a big 20% tax on any profit you do make, and oh, if a trade goes south, the broker might just close your position for you and slap you with a penalty fee for the trouble. It's just this constant, relentless strain on your money. And it gets worse. Beyond all those costs, you're not just playing against other people. Oh no, you are competing against machines. We're talking about high-frequency trading, or HFT. These are automated algorithmic systems that make trades at speeds that are, well, they're literally impossible for a human brain to even comprehend. Just look at this tech gap. It's insane. You, from your home office, might take a few seconds, maybe even a minute, to click a button and place a trade. Meanwhile, an HFT algorithm, which is physically located right inside the stock exchange's data center, is operating in microseconds. That's millions of a second. It sees the data, makes a decision, and acts on it before that information even has time to travel over the internet to your screen. It is no exaggeration to say you are bringing a knife to a laser fight. And here's the real kicker. All this high-speed trading is supposed to be a good thing, right? It's supposed to provide liquidity, which just means making it easy to buy and sell whenever you want. But that liquidity is, well, the pros call it cowardly. It's incredibly fragile. The second things get stressful, think of a flash crash, those same algorithms can pull all their orders instantly, just gone. The market you are counting on literally vanishes in a heartbeat, and you, the individual trader, are left completely trapped as prices collapse. All right, so let's say, just for a second, that you could somehow overcome all the fees and beat the supercomputers. Even then, there's one more opponent you have to face every single day. And this one is you. It's your own brain. Our minds are just hardwired with these psychological traps that are absolutely disastrous when it comes to trading. It all starts with something we're all a little guilty of: overconfidence. You know, that feeling that we're a bit smarter, a bit better than the average person? Well, in trading, that's a killer. It leads people to trade way, way too often. A habit called overtrading. And what does that do? It just pours gasoline on the fire of all those transaction costs we talked about, pretty much guaranteeing you'll do worse. Next up is a really big one from behavioral economics. It's called loss aversion. And it's simple, really. For our brains, the pain of losing, say, $100 feels way, way worse than the pleasure of gaining $100. It's not a fair fight emotionally. And that imbalance, it leads directly to some truly terrible decisions in the market. And this classic flawed decision has a name. It's called the disposition effect. It's a direct result of that loss aversion. Because we hate the pain of taking a loss, we hang on to our losing stocks for way too long, just hoping and praying they'll come back.
And at the same time, we're so eager to feel the pleasure of a win that we sell our winning stocks way, way too soon. We literally do the exact opposite of what a winning strategy requires. Look, the classic rule of investing is simple. You let your winners run and you cut your losers quickly. That's it. But the disposition effect, which is driven by our own psychology, forces us into this terrible losing habit of cutting our winners short and letting our losers just bleed our accounts dry. Our own instincts become our worst enemy. Okay, so far we've been talking about the individual trader. But the damage from this culture of excessive, high-speed speculation, it doesn't stop there. It actually imposes real, tangible costs on the entire economy. There was this brilliant economist, Hyman Minsky, who laid this all out. He basically said that long periods of stability and good times, they actually make us reckless. We start by borrowing safely. Then we move to speculative borrowing, where we can only really afford the interest. And finally, we end up in Ponzi territory, where the whole system depends on prices just going up forever. When that party inevitably stops, and it always does, that's when you get what's called a Minsky moment. And that means a crash. So at the end of the day, all this hyper-speculation creates three huge problems for society as a whole. First, you get the instability of bubbles and crashes. Second, you get systemic risk. That's where one big player failing can drag the whole system down with it, just like we saw in 2008. And third, and this might be the most insidious one, it causes something called allocative inefficiency. So what on earth does that mean? Well, it's pretty simple. It means that instead of money and capital flowing into productive things, like building new factories, funding new research, creating real jobs, it gets siphoned off into the financial casino to chase these short-term paper gains. The money gets trapped in what's called fictitious accumulation instead of creating real, tangible value for the rest of us. So, okay, we've looked at the rigged structure of the market, the psychological traps in our own heads, and even the damage it does to the wider economy. So what's the big takeaway here? How do we get off this hamster wheel and move beyond what is, for most people, an unwinnable game? The whole case against day trading, really, it boils down to three massive barriers. First, the structural stuff. The costs and the technology are stacked against you. Second, your own psychology. Your brain is literally hardwired to make the wrong call under pressure. And third, you have to remember, this is basically a zero-sum game. For you to win $1, a professional on the other side has to lose $1, and they have every single advantage. You know, there's a phrase from the research that just says it all perfectly. For most individuals, active trading is, quote, hazardous to your wealth. It's not just that it doesn't work well, it's that it's actively dangerous to your financial health. It's a reliable way to do worse than the market and even lose your hard-earned money. So what's the alternative? What should you do? Well, the evidence points overwhelmingly in one clear direction: long-term passive investing. Simply buying and holding a low-cost index fund that tracks the whole market. Historically, that simple strategy has beaten the vast majority of active traders, and it takes up a tiny fraction of the time, stress, and fees. It's the boring but effective path. And that really leaves us with one final, crucial question you have to ask yourself. When it comes to your own money, are you playing a game you can actually win? Or are you being lured onto a field where the game is structurally and psychologically rigged for you to fail?